Jenny Horn is with us, and we're taking a look at a bunch of stocks on the move. We'll start with Next Gen Investing. Jenny Horn is taking a look at Google, Alphabet shares that are in the pre-market on the move. A big deal with Meta this morning. Let's hear more about that. Good morning, Jenny.
Good morning, Nicole. And more of this consolidation among some of our tech heavyweights, which I think has been a really interesting theme to see emerge as AI development. I mean, there's so many companies that now are working alongside one another. So that's the latest report we got from the information that said Alphabet's Google has reached cloud computing deals worth more than $10 billion with Meta right now to continue to, further development of AI. As part of the deal, though, the company, of course, behind Facebook will be using Google's cloud for servers, storage, networking, as well as other services. So there's not really given details on what that exactly looks like or how long this partnership will be. But again, I do think this interesting trend of these companies all seeing some degree of not helping one another, but definitely seeing overlap is huge. And $10 billion, I think, is also no small deal. We oftentimes talk about some of these figures as if these companies are much smaller than they are, but it is actually a 6-year cloud deal that is worth over $10 billion. And again, all these companies spending pretty heavily on cloud infrastructure as they do really try to meet this growing demand for AI workloads. Alphabet did say back in July that its Google Cloud unit, which does contain its productivity and software subscriptions, as well as infrastructure, produced roughly $2.8 billion in operating income and around $13.6 billion in revenue. Revenue growth was around 32%. I mean, that was one of our best performing cloud divisions we really discussed. But right now, this deal really centered around all things AI infrastructure. Meta did say also it expects its total expenses in 2025 to range between $114 to $118 billion. So, well, we did get some reports from Meta yesterday. It was freezing its AI hiring spree. It doesn't appear that it is at least ceasing spending regarding AI, and this deal further does prove that.
And, it's interesting because yesterday we had Meta news that they are freezing hiring after spending millions of dollars, 9-figure pay packages, and now a lot of reorganization and focus, maybe trying to streamline. So it's interesting that they have this cloud services deal now with Google. And we always think that they're all in a battle with each other, but here they are, playing nice in the sandbox. The group overall, tech has been under some pressure too.
It has, and I think that's exactly, today, I know we're poised to open higher today, but that has also been I think a huge part of the concern over, the rest of the price activity for August into September, because historically these are weaker months, but when you have big tech turning over the way it has, I think, look no further to NVIDIA, for example, or Microsoft, two of the heaviest weighted stocks in the S&P 500, for why the market is lower. Because if you have these names rolling over, you're going to see the turnover in the market. And right now, the degree of really influence these names have over the S&P 500, for a specific example, is never been higher. Like NVIDIA alone accounts for about 8% of the index, but the 5 largest names account for over 30%. So that speaks to the broader market. You can't expect a rally in the market without the participation of your NVIDIAs, your Microsofts, Metas, Alphabets, and Amazon and Apple. And it's actually been amazing to see the market be as strong as it has the last few months without the notorious leader being Apple. Now, seemingly the focus is a bit more on NVIDIA.
Yeah, understood. I'm looking at Workday here, which is under some pressure, at least for the guidance part was not what Wall Street wanted to hear. And the chart's not a pretty one either, that being said. What do you think? What are folks focusing on when it comes to the quarterly report here?
Yeah, this is really interesting because I do feel that these software exposed names have really struggled post-earnings, or at least on their guidance front, in the back half of this earnings reporting series. They did beat their estimates, but CEO warning of these challenges specifically in education and government. Revenue, though, increased about 13% from last year. We also saw the net income was around 84 cents. That was almost double year-ago levels. And for the current quarter, they're calling for about $2.24 billion in now subscription revenue and $180 million in professional services, which implies roughly about $2.42 billion in total revenue. That was exactly in line with the street's expectations, as well as they see adjusted operating margin of around 28%, slightly below what had been expected. But they do now see about $8.8 billion in subscription revenue for the full year, $700 million in professional services revenue. That implies some decent growth. And that is also, if you took the total of those two figures, ahead of consensus. They did say that right now they've seen these governmental challenges throughout the quarter, saying that right now people are trying to figure out what the funding slowdown is going to look like all the way to the state level. Meanwhile, also higher education in the U.S. is facing pressure from President Trump, who signed an executive order back in March to shut down the Department of Education. So they also did mention it's something they're keeping their eye on, as well as the healthcare system, and said that they also are acquiring Paradox, which is the company that's focused on these conversational AI software, really tools for recruiting, as well as, just overall furthering their AI reach, but there was not a disclosed sum attached to that deal. So very mixed picture here, but the software names, unfortunately, have really struggled. It seems like resonating well with the street with their guidance and then their post-earnings moves.
Yeah, and big picture here, we're talking so much about cloud. We're back to cloud again. And yesterday we were talking about Dan Ives' ETF. Now it's the AI Revolution ETF. Ives, we always remembered it as being more cloud focused. But today, I'm looking at a name like Snowflake, for example, and that name is doing a little better than a name like Workday. But the group overall, a final quick thought?
The group overall, it's interesting because I don't necessarily agree with the financials matching some of the post-earnings moves. What has done quite well in software still has been anything linked to cybersecurity. That seemingly has been a bright spot, although mixed picture post-earnings moves again. So a lot of these names, I think it's going to be a challenge to grow at the pace that the market had already priced in. And that's where we're seeing some disappointment, or maybe just overall pullback here, as expectations for these names had run up so high, and then seemingly that high bar, they're not shelling out enough cash. They're not the biggest names in tech, and that right now has resonated well. Some of these smaller companies, I think the growth story will be a bit more challenged. But overall, still in software, you could make the argument cybersecurity has been the brightest spot.
All right, Jenny Horn, great to see you. Thank you so much.